Gold has formed a weekly bullish candle, recovering after a sharp correction. Now the big question, will this momentum push gold surging toward 4,400 or trigger a sharp correction almost no one is ready for? But here's the truth. Most traders miss gold's biggest moves because they don't truly understand the forces driving this market right now. In this breakdown, I'll reveal how institutions are quietly positioning, uncover the 3 macro forces shaping gold's next move, and share my exact trading roadmap for the week. If you're serious about trading gold, stay with me till the end. I'll show you exactly what's driving this market and how to trade it. Macro outlook: 3 key forces driving gold. Force number 1, geopolitical risks. Recently, the US has deployed F-35 fighter jets and various military assets near Venezuela. Caracas responded immediately, activating its S-300 air defense systems, reportedly ready to engage any US aircraft. It's not just politics, it's a clear sign of rising global tension, and gold always reacts to that. Russia-Ukraine peace talks show some progress, but no deal yet. Until a concrete agreement is reached, uncertainty will keep gold supported as a safe haven. That's just the first force, but the second one is even bigger: the US dollar. Geopolitics steal the spotlight, but the real fight is happening in the dollar. Force number 2, the US dollar dynamics, DXY. The dollar remains the most important counterforce to gold. Here's what you need to know about DXY. DXY technical analysis. Starting with the weekly chart, following last week's failed bearish pin bar breakout, DXY continued to close lower this week. For the dollar to break above the key 100 resistance level, it may require a prolonged accumulation phase. If price fails to break above 100, a deeper correction toward 97 to 98 region may occur before any sustainable upside momentum resumes. In the bullish scenario, where DXY decisively breaks above 100, upside targets would shift toward 101.50 and 104. On the daily chart, DXY is currently trading within a short-term ascending channel and is retesting the lower boundary. From here, a short-term rebound toward the previous high at 99.8 to 100 is possible. A confirmed breakout above 100 opens the path toward 101.5. However, if price fails at 100 and forms a double top structure, a bearish reversal may unfold. A daily close below 98.6 would likely confirm continuation toward 97 to 98. Zoom into the H4 chart. On the H4 timeframe, there was a strong bullish candle with high volume when price touched support at 98.6. This suggests a possible mild recovery toward 99.4, 99.6, and the 99.8 to 100 zone before pulling back again. The likelihood of breaking above 100 is low, especially after the earlier failed breakout candle at 99.8. Here's the catch. DXY's next move won't just impact gold, it could rewrite the short-term trading landscape entirely. Now let's look behind the charts at the institutional flows shaping gold's next move. Finally, institutional activity. While retail traders are still debating whether gold has already peaked, Gold Trust tells a different story. Despite selling 5 tons during the recent corrective move, Gold Trust has actually increased their net holdings by 8 tons over the past 3 weeks. They haven't significantly reduced their accumulated positions, which shows strong confidence in gold's upside potential. Large institutions continue to buy, signaling expectations for higher prices ahead. When capital of this magnitude shifts, it's not just market noise, it's a clear message. Retail traders often get trapped chasing moves too late, and that's when the real game in gold begins. These activities suggest the fund is still positioning to push gold toward the 4,300–4,400 range, possibly further to 4,700 to 5,000 before taking profits. This positioning aims to hedge against a possible Ukraine peace deal and a potential US dollar rebound. Now that we understand how capital is moving, it's time to turn to the charts. Let's zoom in and see what gold is really telling us. Gold technical analysis. First, congratulations to everyone who acted on my October 29, 2025 analysis by buying near 3,900. They're now enjoying gains exceeding 3,000 pips. Meanwhile, those who followed last week's breakout strategy around 4040 have secured profits of over 2,000 pips. We called this move from 3,900 before it even started, and that's the power of understanding market structure. We shared this setup earlier in our Telegram group. That's why it's crucial to subscribe to the channel or join our Telegram to get real-time updates so you don't miss the next major wave in gold. Now let's zoom in on the charts. Weekly, daily, H4, step by step, here's what the market is really showing. Starting with the weekly. Since bottoming at 1,600, gold has surged to 4,400, a move of nearly 28,000 pips. This rally was fueled by four converging forces. The dollar's dropped from 114.6 to 96, geopolitical risks in Ukraine and the Middle East, trade tensions under the Trump administration, fiscal risks, government shutdown in Washington. Ask yourself, how often do we see such perfect alignment? It could take more decades or never happen again. At this stage, peace in Ukraine remains elusive. Tensions between the US and Venezuela are escalating, and global markets have yet to find solid footing, all of which continue to support gold's upside momentum in the coming weeks. However, a strong rebound in the US dollar, DXY, could easily trigger a sharp correction in gold from current levels. On the other hand, if DXY continues to consolidate or weaken, gold is likely to rebound to 4,200 if break decisively above the 4,250, paving the way for a potential rally toward 4,300, 4,400, and beyond. On the weekly chart, after two bullish pen bars, last week closed higher exactly as anticipated, with price reaching 4,250 before pulling back, confirming strong underlying buy-side momentum. In the coming weeks, gold may continue to consolidate within the 4,000–4,400 range to build sufficient momentum for a potential breakout above 4,400. If 4,400 is breached, upside projections extend toward 4,700 and possibly 5,000. Only if gold closes below 3,900 would a deeper correction toward 3,800–3,700 become likely, though this scenario currently has a lower probability. Shifting down to the daily. Now let's look at the daily chart. This is where the broader story unfolds. Gold remains in a triangular consolidation. After building a base around 3,900–4,000, price broke higher strongly. The latest two daily pullback candles were mainly triggered by broad market sentiment as SPX 500 corrected sharply, combined with US tariff reduction headlines on Swiss goods and essential imported food products, while DXY experienced a minor recovery. Gold is currently retesting the previous breakout zone near 4,050. With SPX 500 now recovering, gold may rebound toward 4,200 and experience a mild pullback before attempting another move toward 4,250. If 4,250 breaks, continuation toward 4,300–4,400 becomes highly likely. So let's zoom into the H4 chart, where things get even more interesting. After a strong decline from 4,070 driven by SPX 500 pressure, price reacted robustly at the 4,030–4,050 support zone and bounced higher. Given that the prior sell-off was relatively strong, gold may retest 4,030–4,050 before resuming its recovery. A confirmed breakdown below 4,030 would expose 4,000 for another retest, where buyers may re-enter. Moving down to the H1 timeframe, H1 shows strong bullish candles with notable volume at the 4,030 support retest. The recent 5 pullback candles were limited in size with visible lower wicks, indicating sellers are not dominant and buyers are actively defending price for another leg higher. H1 RSI also supports a bullish continuation scenario. Short-term pullbacks are likely to remain shallow before a stronger recovery. If gold closes above 4,100 on H1, the next targets would be 4,150 and beyond. This structure gives traders a clear multi-time frame view. Overall structure remains bullish, with the current pullback seen as a healthy correction within the uptrend. All of this leads us to the key question: why consider both buying and selling gold at this stage? Gold stays in a strong bullish cycle supported by institutional demand, ongoing central bank accumulation, and solid technical setups. However, the DXY rebound remains a key headwind to watch. Let's turn that analysis into a practical trading plan, the exact playbook I'll be following for the week ahead. Trading plan, November 17th to 28th. First buy zone, 3,900 to 3,935. Institutional support, round number, fail break, probability approximately 95. Stop loss, 38.89. Targets, 39.97 to 40.27 short, 40.97 to 41.47 mid, 42.45 to 43.77 long. Second buy zone, 39.80 to 40.05. H4 support, round number plus rising trend line approximately 90%. Stop loss, 39.78. Targets, 40.27 to 40.47 short, 40.97 to 41.47 mid, 42.45 to 43.77 long.
Third buy zone, 4,030 to 4,073. Nearest support, H4 breakout support, probability approximately 85%. Stop loss, 4,027. Targets, 4,097 to 4,127 for short, 4,144 to 4,167 for mid, 4,197 to 4,245 for long. If you're still watching, you're already ahead 90% of traders. First sell zone, 4,237 to 4,249. H4 strong resistance, probability approximately 85%. Stop loss, 4,251. Targets, 4,221 to 4,203 for short, 4,153 to 4,103 for mid, 4,073 to 4,043 for long. Second sell zone, 4,377 to 4,400. All-time high, probability approximately 95%. Stop loss, 4,401. Targets, 4,353 to 4,303 for short, 4,253 to 4,203 for mid, 4,053 to 4,003 for long. Pro tip: false breakout, wait for the retest, re-enter for clean profits. Remember, probabilities don't guarantee outcomes, but they keep us disciplined. Gold doesn't move randomly, it reacts to real global shifts. Don't follow the crowd, trade with clarity, not emotion. Subscribe now and join our community for real-time alerts and exclusive insights. Never miss the next big move. Master gold, master the market. This is not financial advice.